As I said, we have one more, session over here, which I said again, finance gurus are here, so it's not never ending, and I don't want to end it as well. So they will be talking on alpha opportunities with alternatives and various fund infrastructures over here. May I please call on stage G. Senthil, Chief Business Development Officer, KFin Technologies. Everyone, a big round of applause. Then we have Hemant Daga, co-founder and CEO, NEO from Asset Management. Everyone, come on. Then we have Miss Lakshmi Iyer, CEO, Kotak Investment Advertisers. Everyone. Siddhartha Bhaiya, MD and Fund Manager, Aequitas. Vineet Sukumar, founder and MD, Vivriti Group. Everyone, come on, a big round of applause for them, guys. Over to you, ladies and gentlemen. Thank you so much.
Thank you all. It's been a brilliant day so far. So after Prashant's session in the morning, we have a lot of discussions around the fund administration and operation process. Today I have an eminent panel again to discuss on the alternates per se, more on the product side and on the investment strategies. So I'm glad that most of them would be sharing their views. So I think like it's very lopsided towards a fixed income panel. Siddharth, you are the odd man out. So before we start, like
sign of changing times. Interest moving from equities to the fixed income.
So just to give a brief, like the entire industry, alternate industry has been growing at a significant pace, and we have been seeing tectonic shifts across the category. And there has been significant amount of growth, especially in the category 2 funds. That's very clearly evident from the panelists over here, and most importantly on the fixed income space. So we'll just quickly get into the discussion on alpha opportunities with alternatives. So first question, I'll just put on to Lakshmi. So this is a very basic question. So you have been on the mutual fund side also before. So typically, why do you think investors should look at alternatives as an option? So when you have so many other mutual funds, traditional funds which are there in the market, what is the one main reason investors should look at alternatives?
Thanks, Senthil. Hi, very good afternoon to each one of you. Siddharth and me were just discussing that we are just worried that the audience might go into a slumber mode because it's just the post-lunch session. And there is very limited masala that you can add to a discussion like this, very honestly. But let's hope his anecdotes are alive and kicking, and that will give us all some cover for life. So on this point, Senthil, there are 2-3 key important things that we need to keep in mind is that when an investor, he or she is coming into, say, a mutual fund or through the alternate investment fund route, one needs to understand what is it that the underlying is going to be offering to you as an investor. For example, on a Friday night, if there is, a Sitar Vadan and a Bollywood movie release, my preference is to go to a Bollywood. I'm not saying that the artist is not good, but probably my cousin, who's coming from Baroda would find that much more interesting, and therefore he might actually go in over there. So it's basis your understanding, basis your risk appetite, and basis what is palatable to you, it is what will suit you. And second most important thing is that the underlying vehicle, what does it permit you to do? I think these are the 2 key criteria. So if I therefore toggle from mutual fund to alternate space, mutual funds are reasonably prototyped. The lowest rung in terms of expectation of returns is the overnight fund, which is found in fixed income. And the perception that the highest return potentially possible given the risk appetite and the concentration, etc., is a thematic or a sector fund. Under that or within that, you have the entire thing, right, from liquid fund to diversified equities to low duration fund and all of that. And when we toggle that to the alternates bucket, you realize that you can, create multiple underlying and it is not necessarily restricted to the listed space, whether it's in the equity side or fixed income side. So what gives you your happiness quotient? What is your poison, as they ask you? Usually these days, everything is poison. But in general, I think that is what is leading more and more investors. And, there is this, the tagline in Surf Excel, no, "Dag dhoonte reh jaoge," recently or more recently in the industry is "Alpha dhoonte reh jaoge." So in that pursuit of alpha, you are trying to find more and more investors. And of course, with mindful of the kind of risk that they want to have, finding a vehicle called the alternate investment platform as one of the kosher mode of gaining that participation.
Sure, fantastic. So now going to Siddharth, so continuing to what Lakshmi mentioned. So in terms of alpha, when you talk about alpha, so especially in equity markets, typically in the long only funds, the markets are becoming very operationally and informationally efficient. So today we find like most of the long only fund managers are not able to beat the benchmarks on a TRA index. So in this kind of scenario, you operate in a very similar kind of a construct. So how do you think like alternatives can generate that risk-adjusted returns when broader markets are beating most of the fund managers?
See, I think to be honest with you, there's no, I've heard this theory about markets becoming more efficient for the last 20 years. 20 years back, there was no internet. Today, there's internet. Everybody has access to the same information. A retail investor has access to the same information as a professional investor does. So I think generating alpha is more about, it involves a lot of contrarian investing, right? And typically, there's too much pressure on mutual fund managers on a daily basis to report their NAV. So they cannot really take contrarian calls. So an alternative investment fund kind of gives us that liberty, right? Because it's not a mass market product. It's a very specific product for a specific clientele. So we have a one-on-one relationship with all our clients, and it enables us to tell them what we are doing. Rather than customizing products for them, this is what we do, and if you like us, you can invest with us. So I think it's very difficult in a mutual fund format right now to deliver alpha because of the inherent pressures. If I was a mutual fund manager, I would have lost my job 5 times over the last 10 years, So,
so just an add-on to that question, since you mentioned that, see even today most of the Cat 3 AFs, so they are providing a daily liquidity window and it's a unitized product. So how different it could be like? So still it operates like typically like a mutual fund, right?
The number of clients, your minimum ticket size is 1 crore. So you're not necessarily dealing with a very sophisticated client, but the number of clients that you're dealing, the number of touch points, right? The intermediary, typically a person who's going to give you a 1 crore check would want to meet you or somebody from your team. Whereas in a mutual fund format, you barely ever get to meet the fund manager. So that's a big difference. So the investor is in a much better position to understand the fund manager.
Sure. So now a question to Vineet and Hemant. So both of you, since you are in a similar, I'm not able to surely like distinguish between the strategies which you operate. Maybe as we move on, we will just dwell on it. But what I feel is today, large chunk of the business which is coming into alternatives, especially in Cat 2 funds and PEVC funds, is largely the overseas money, the institutional money, whether it's a foundation or an endowment or large pension fund overseas, or typically the NRIs abroad. There are very limited institutional participation from domestic institutions. So do you think this scenario would change, or it is already there has been flows coming in? Vineet, maybe you want to take it.
Thanks, Senthil. I think, unfortunately, as far as Indian context is concerned, institutional participation is also limited by regulation. For example, banking regulation today still hasn't differentiated between investing in VC funds and investing in AIFs at all. Right? The regulation was written probably 12-15 years back. Right? Insurance companies are still not allowed to invest more than 3% for a life insurance and 5% for a general insurance, which also has to be split between 5 AIFs each. Right? Pension funds just got an approval to come below AA+ ratings. So now, pension, insurance, banks. Right? Each of these are carrying very severe limitations in terms of what they can and cannot do. Right? So how does the institutional market develop, right? And what incentives do banks, insurance companies and pension funds have to evaluate an asset manager when the sum total of investment they can make is a paltry double-digit crores, right? So these are fundamental questions staring at us in the face. Is the market interested? 100%. We have seen very interested public sector bank treasuries, pension fund managers, NPS fund managers who are calling us and talking to us. But their degrees of freedom to invest is poor. You're right that a vast majority of the category 2 investment has come from offshore, and that trend was also fueled by a little bit of easy money, so to speak, and that's slowing down ever since market rates have changed radically for the worse in the last few months. And therefore, the Indian market does have to compensate in some fashion. Today, we see much more promise in the private wealth market than the institutional market, unless regulations change.
Hemant, your take on this? And just to add on to one more question, see, recently there was a regulatory change also, like even provident funds and pension funds were allowed to invest 5% of their incremental corpus in alternatives. So has that been picked off? Just an add on to.
Actually, Senthil, if you look at world over, even insurance companies in the US, a large part of their asset management is done by professionalized asset management companies. And I'm sure that in the future, sometime maybe a few years down the line, I think insurance companies in India will realize that probably asset management is left best to asset managers. And they don't need to build all the skill sets in-house, right? And it's a matter of time. I think currently we are talking of percentages, whether 3, 5. But I think the bigger point is accepting that you're good on lazing liabilities and you should leave asset management to somebody else. If that can happen in the US, where 401 schemes are managed by asset managers, I'm sure someday in India, insurance companies will pass on their asset management to Indian specialized asset managers. Coming to your specific question, which pools of money are currently getting momentum? I think there are diverse pools of money. I think globally, India stands out. I think India is a $3.5 trillion economy. No economy in the world of this size has positive real rates, okay? I think despite whatever you say, I think India will stand out, especially in the fixed income space, especially in the Indian equity space. Whether money will have some troughs, ebbs, I think that will continue. But in the next 5 years, will India get a lot of money? The answer is a yes. Will high net worth individuals allocate a lot of money? The answer is a clear yes. Where do they get these asset classes to participate in real assets and make 10 to 12% returns without the volatility of equity markets? I think insurance companies, provident funds, will they take time? Probably the answer is yes, and let them take their time, because it's better that they take time rather than having hiccups once they start. So I think the flow of money is not a question, okay? I think we are fortunate to be in India at this time when this industry is truly picking up. 6.5 lakh crores is the alternative industry. It was probably 50, 60,000 crores 7 years back. You can't expect for more money to come. It's just to educate investors and clients to get them into the right strategies. Eventually, more and more money will keep coming.
True. So now, again, Lakshmi, I just take the liberty of asking you this question again on performance. Again, back to the same mutual fund story. So mutual funds as an asset class is pretty much standardized and homogeneous, right? So now, after SEBI coming up with the categorization, it has become even more standardized. Whereas alternatives, like within Cat 2, you see different strategies, different sub-strategies, risk profiles are different. So as an investor, how do I look at the performance persistence of, in assessing the alternate, which alternate fund should I choose?
So if you are going to compare the mutual fund categorization vis-a-vis what is happening in AIFs today, it is actually an X-ray versus a black sheet of paper. You can see through an X-ray, you can't see through a black sheet of paper clearly. I'm not saying therefore that, and it's a relative concept that I use, because mutual funds are super transparent. In the earlier panel, I think there was a discussion around you get to, on the mutual fund NAVs, you get it the next day. I'm telling you, it is published on Amphi website before 10 p.m. or 9 p.m. in the night. So it's all available for you. It's a daily treadmill. So therefore, the standardization is much, much more. And as Siddharth was saying that it is catering to the mass market. So for example, even my maid has an SIP because it's a 500 rupee ticket size, so she has access to it. And because of further democratization and these online portals, even a 100 rupee SIP is possible. Is that possible in the alternate route? Answer is no. So the vehicles are very different and therefore the participation and the ecosystem around it is very different. So therefore the yardstick of measurement also is going to be different. So for example, even in a mutual fund scheme, for example, if you have a similar category, so let's take the short duration category. There is a 1 to 3 year duration bucket, but it is the duration is sacrosanct, so it cannot be under 1, it cannot be beyond 3, but it does not talk about what kind of credit you can. So can the 20%, 80% being AAA, can 20% be non-AAA? Answer is yes. Likewise, in a dynamic bond fund category, can you have 100% gilt, 100% state loan, or 100% corporate bonds? And in that also you can do a mix and match. The answer is yes. So within the homogeneity, there are some small pockets of heterogeneity. Whereas if you look at the AIF, given that the nature and structure of each scheme is distinctly different from the other, what you therefore need to look at is obviously the pedigree of the manager, which is a common principle for identifying even see, Rajnikant was acting maybe 20, 30 years back, he is acting even today. The general perception is, ठीक है यार, आज की तारीख में भी act कर रहा है तो शायद picture hit ही होगी. Flop होगी वो अलग बात है, but I'm saying at least ab initio you're going with that mindset. So that's a good starting point, So if you have a pedigree, so he or she branches out, from a mutual fund and starts or launches a vehicle to participate through AIF, the general perception is, yeah, he or she has done well, therefore the continuity may exist. So that's number one for sure. The second thing is, what is the underlying? Obviously, are you looking at listed equity? Are you looking at private credit space? Are you looking at the VC funding space? Are you looking at the very, very late stage funding? So each of these, so for example, even in the unlisted space, the early round series A, B funding underlying would be distinctly different in terms of its risk profiling. Even in the private credit space, now you have the entire diaspora of 8% lower side to 18, 20% or close to 18% in the performing credit space. So there again, the entire thing is probably a very, very long tail. So therefore, there cannot be one size fits all. So the standard benchmarking that is available in mutual funds may not be relevant and true for the AIF industry. And therefore, it's very important that we need to harness on the fact that disclosures should be reasonably commensurate, which is where you've seen a series of consulting papers also by the regulator, where they want inputs from industry makers, both investors, asset managers, advisors, all of them, to say what better can it be done. Where we are today to, as Hemant said, where we were maybe 5, 7 years back to where we have, there is certainly a lot many eyeballs that have been raised, for the AIF industry. And trust me, those eyeballs are only going to widen, it's not going to shrink. So it's therefore equal responsibility as a manufacturer, as an investor, to A, make the right set of disclosures, to push towards standardization wherever you can. For the sake of standardization, don't do it, but wherever you can, certainly push for standardization. For example, in mutual funds, you have a direct plan and you have a distributor or a broker plan. In AIF, that is mandated. In AIF, there is a provision. How many of them are using that provision? So, make some of these mandates. Self-regulation, sabko nahi hota hai. There is something called as tolding, which is what I used to share with my team. Not the right English. Don't focus on the English, focus on the intent. There is something known as tolding, and there is something known as scootering. Scootering matlab khud kickstart karo. Tolding matlab maine tumko bola hai, tum karo. So I think some bit of it, I think we need to morph from the scootering stage to the tolding stage, because kickstarting is not really working. But can you emulate a mutual fund entirely? I don't think it's fair to do that. You cannot do that, because the nature of the beast is totally different. If you are going to drive from here to Alibag, you will drive down because you enjoy drive. I don't know how to drive. I want to save time, so I take the Roro. Are you wrong? Am I right? Answer is no. We both are right, and of course we are right because of our own requirements.
Siddharth, just extending this to Cat 3 funds. See, very similar kind of situation. See, there are umpteen number of Cat 3 funds are getting launched, not only domestically, even in GIFT. We have seen a lot of traction, especially on the Cat 3. So what is very pertinent is the best performing funds and the worst performing funds. See, the first quartile versus the fourth quartile, there's a huge amount of difference between the performance.
Correct.
In that case, like as an investor, as a large investor, I may end up investing in a wrong manager.
Right.
So how do you counter that?
So again, as I said, Lakshmi has made a very pertinent point, right? Our industry is very nascent, right? Our regulations right now, we have a fund out of DIFC, we're looking at Cayman, we're studying, Singapore. Our regulations are comparable to any other regulation as far as the fund, the alternative investment fund category is concerned. Over there, you're allowed to market to professional. Even here, you're allowed only to market to professional. And fairly similar, the regulations are very similar. The problem is going to be in terms of implementation, in terms of the legal recourse that is available to the investor. The reason why the AIF industry or the alternative industry in US has exploded is because there is a very strong recourse available to the investor. So any industry which is growing and growing at the rate at which our industry is growing is going to also attract a lot of unscrupulous elements. We're seeing that, right? That is why SEBI has gone so strict on so many new regulations. While we can complain that every Friday you're getting new regulations, but the fact of the matter is, within the industry, people are abusing the laws and regulations. So there will, over a period of time, as reporting standards improve, as transparency within the industry improves, people will be in a much better position to take an informed decision. Today, in a mutual fund, everything is available. Right, so a retail investor is in a position at the click of a button to take an informed decision because it is standardized. In the AIF industry, it is all over the place. So it's going to take time, right? We'll probably degrow before we grow again. So yeah, I think there is time. A retail, for a layman without access, we don't have all the information available. So it's very difficult for anyone to take a really, really well-informed decision. Am I right, Lakshmi?
And there's a business opportunity, by the way.
Absolutely. So just shifting gears now. So we'll just deep dive into fixed income. So before I just have series of questions for Vineet and Hemant. So again, coming back to you, Lakshmi, to just set the context. See, mutual funds face the credit crisis, right? So where like all of them were exposed to duration, interest rate, duration risk, credit risk as well as the liquidity risk. So within an AIF structure, how do you manage these three levers of risk? So maybe like Vineet and Hemant will add on to it. So I just want to take the initial round of comments from you.
Yeah, sure, because I'm actually toggling between these two roles, so I can at least kickstart some of this, and then Vineet and Hemant can add on. I'll tell you the very crudely put, okay, in that space, in the performing credit space, AIF has the potential to eat meat, whereas mutual funds have to be content with mock meat, very clearly. That is point number one. And why I say that is because every day, if you have to give an exit and make sure that there is fund available irrespective of the nature of liability. Of course, now there is a liquidity measure, etc. that's come in. But it is extremely, extremely tough on the money manager to be able to go down the credit curve very meaningfully. That's number one. That's not the case in case of the AIFs, number one. Number two is closed-ended funds. How long can you do? You can do that for 3 years, 4 years, 5 years. Again, the similar thing comes in that how lower down the credit curve you can go. Investment grade credit, below investment grade credit, also unrated. Also, there are multiple opportunities, as we can call it, in equity parlance, the large cap or the mid-market group, and of course the small cap kind of opportunities. There are a plethora of opportunities in the performing credit space. And by performing credit, I'm talking about, the grade, as I said, lower end of maybe 10, 11, 12% to upper end of 16, 17, 18%, which may or may not be tapped to its fullest potential by the mutual fund managers. Only because, not because they don't understand it, it is because the nature of liability is such that the appreciation of something like this is not there. So therefore, I think the underlying crux of liquidity is not so much of a challenge with the AIF, but the credit and the duration part still remains. So that bit you cannot, but the leeway or थोड़ी ढील छोड़ना जैसे हम बोलते हैं, that deal is a little bit longer because here you can structure these funds with a 3-year, 4-year kind of a thing. You can put steep exit loads, which as I said, is quite utopian in the mutual fund world. And again, it's very widely distributed. This is available on every portal. So if you are 5-star and if you are, a rock star performer in the last 12 months, you get a 5-star rating, matlab 1, 2, 3 years. And uninitiated people like my father, for example, I'm initiated. My dad is not in the, financing world. He's part of the manufacturing world. So he might just say, oh, there's a 5-star fund. Let me look because this is the category that I like. Oh, it's looking exceptionally good in the last 12 months or 15 months. So as I said, therefore, those kind of compulsions are clearly not there in the AIF world. The manufacturer can decide who I want to sell this to, who I want to offer this to. I can decide I want only X amount. I don't want 2X, 3X, 5X. You're not in the AUM. So I'm saying all of that, therefore, make a credit kind of an underlying a great way of, I would say, offering it to the investment fraternity through the alternate vehicle.
So now coming to Hemant, let's little more get more granular into the fixed income credit funds. See, today investors are like bit confused because most of the investors are confused between BBB, A-, or whatever be the credit rating, credit upgrades, credit downgrades, because it's become a frequent phenomenon. And today, if you see, more than 90% of the losses have come from AAA rated category, right? Whatever we see. In that being the case, as an investor, how do I get confidence to go down the credit curve in terms of how do you counter this with the investors, and what is your conviction in just positioning this to the investors?
Sure. I think this is a very relevant question, and a lot of people ask these questions. When we invest as AIF asset managers, I think a lot of our investments are unrated. But just being rated doesn't mean that the holy grail has been achieved, right? Banks do a lot of unrated lending. It doesn't mean that it's not investment grade. In fact, if you look at banks' books, most of the lending is unrated, right? When you're lending to an SME, it is unrated. But it doesn't mean that it's not investment grade. I think financial metrics should define safety versus just rating defining safety, And I think gradually investors will realize, just as they have realized in equity markets, finally it's about a certain ratio, a certain financial metric telling you whether you are a great company or whether you are an average company. Both of you actually can be large caps, right? But one large cap will be untouchable, the other will be, wow, it's a great company. But how are people deciding it? It's just not getting decided based on large caps, right? It's getting decided based on at least one level deeper, going down and peeling the onion and figuring out whether this has leverage, that doesn't have leverage, this has mutual fund as its investors, this doesn't have mutual fund as its investors. And then you finally take a more nuanced call. I think that is what AIFs are doing. I think rating is not the panacea in that sense. Sometimes you can get great opportunities when a company might be actually financially doing better, might not be rated, but technically you are lending it at far higher rates. And that is what asset managers are seeking to do by providing these alpha generating opportunities in that sense. Also, I must tell you one thing. I think, in the business of credit, people use these terms default, credit downgrade. I think these are terms which are used relatively loosely. A downgrade doesn't mean that the company has ceased existence, right? Similarly, a default doesn't mean that your capital has gone whitewashed. I can default, but I can come and pay back. So I think default and capital loss is something that we should start distinguishing between. And I think it is imperative to teach investors that default can happen. I mean, I'm walking on a road, I get hit by a car. If I get laid off, maybe for 2 months, I will not be able to service my EMI. But if I'm a great asset, I'll find a job again, and I will again go back to the job market, and eventually I will be able to pay my EMIs. So default is not the be-all of, be-all and end-all in that sense. So I think some of these concepts, whether rating is be-all and end-all, necessarily do not agree. Whether default is, the death knell of a company, we don't necessarily agree, okay? I think default and capital loss are very, very distinguished concepts, and we should appreciate the difference between the two. So overall, I think in fixed income credit markets, I think these differences do matter. Just one more thing I want to add. I think diversification in fixed income is super critical. You know, when you invest in a single bond, can that bond default? Can you have a loss? Yes, the answer is clearly yes. But I'll just give you a data point. And this is, you know, I was surprised at this data point myself, being in fixed income markets for several years. Assume you construct a 20 bond portfolio, and you're looking at delivering close to 20% IRR. Assume min-max investments will be 5 to 7% in every. Assume एक investment ना problem हो जाता है. Assume you lose principal. If you lose full principal on one investment, you know, mathematically the 20% portfolio IRR will drop to 18.7. And that is something that we need to appreciate. I think when you diversify in fixed income, your losses will not be earth-shattering. It won't mean that a 20% portfolio will drop down to 8. It will drop down to 18.7. Are you getting compensated for that? Probably yes. So I think diversification is very important, and investors should look for that when they are looking at asset managers.
Rightly said, Hemant. So, Vineet, now coming to you. So Hemant mentioned, just also clarified that lower round the credit curve also there is merit in investing. But if I look back historically and see over the last 5 years and 10-year returns, so your credit funds have not been the top performers, your duration funds have not been the top performers. The best performing category is a constant maturity gilt, okay, which is a passive strategy, which is given close to about 6.5% net of tax, net of expenses. So when I'm, as an investor, if I'm getting 6.5 in a passive with no credit risk, so why should I even look at something beyond that? So is there any merit in just looking beyond that, or does this really give us any better opportunity in the credit space, especially through alternatives?
So I think great question, and we get asked that all the time. And I think one part of the answer is just allocation, right? Because in every investor's portfolio, there is place for equities, there is place for risk-free, and there is place for earning returns that are well over risk-free, right? Today, if you look at the realm of alternate investment funds that exist, ranging from say 12% to 20% or even higher, venture debt funds could give even higher. The post-tax returns could range anywhere between 7.5, right, going all the way to 10 to 12% depending on the strategy followed, right? Now, tax is definitely a significant factor today in every HNI investor's portfolio, and therefore decisions always get made on account of the post-tax returns. And the kind of premium available on alternates versus a constant maturity portfolio is anywhere from 2 to 3% today in today's market. But one must remember that this is probably at the highest end of yields that we have seen. Had we seen the same question perhaps a year back, the equation would have looked very, very different, right? Because these funds are exposed to MTM as well. Whereas the stability and predictability that you typically see in a fixed income credit fund is much higher, which remains high irrespective of the cycle. Why does that happen? What happens is that typically the highest side of the market, the AAA and the AA market, moves very, very along with the repo rate. So today, for example, if repo has gone up by 250 basis points, AAAs have gone up by a very, very similar number on yields, right? But when the market corrects, the reverse happens as well. The BBB and underrated market is very price inelastic, right? So let us say a BBB that was paying 14% a year back is perhaps paying 14.75 now, but will not come back down by 250 basis points either if repo comes all the way back to where it was a year back, right? So in markets where interest rates are very high, alternates look less attractive. In markets where interest rates are very low, alternates look phenomenally attractive, right? Coming back to, I think, a fundamental point, again, adding to what Hemant said. Today, in any market, typically, 20 years of rating information has shown us that that BBB defaults are approximately 3.25%. The premium available for holding a portfolio of BBB is 8% over risk-free, right? Which comes back to what Hemant said. The moment you diversify enough, right, it's very difficult for you to lose out.
Okay. So Hemant, now coming back to you again, so what are the major drivers of private credit markets? So is that like banks are not reluctant to or reluctant to lend to these sectors, or asset managers are taking informed decisions? Like, especially some, I just want to understand more on the, because this is again a loosely used term, private credit.
Sure.
So how do you differentiate this, distinguish private credit from?
So actually, Senthil, if you look at this, I think post the Lehman crisis in 2008, I think globally regulators want banks to be very, very tightly knit institutions. They have a fiduciary responsibility and they should be highly tightly regulated. I think this is a global trend. It's a trend that is happening globally. So even if you look at globally, I think the rise of private credit, direct lending, special situations, I think these are all interchangeable words in some way. I think post 2008, I think this industry has picked up significantly. And asset managers are great suited vehicles for doing this because there is no asset liability mismatch, as Lakshmi was explaining. And asset managers, the vehicles are well suited. I think even from a skill set perspective, all said and done, I think incentivization at an asset manager level is far superior than at a bank employee level. So you're getting great talent to underwrite credit pools. And which is why, this trend is moving away from banks globally. It's not happening in India alone. It's happening globally. More and more direct lending, more and more private credit is happening by asset managers. And it's happening in India also now. I think if you look at it, banks are increasingly getting regulated. I think banks do have to follow certain rules. I mean, if you take a working capital, if you take a home loan, right? My documentation and Senthil's documentation will exactly be same. What can only be different is the rate. Senthil will get 7 quarter, I will get 775 for sure. But tomorrow if I go and ask that I need a 6-month moratorium, I won't be able to pay my home loan for 6 months, I don't think any bank can accept this request, right? So any amount of structuring, any amount of flexible credit underwriting just cannot be done by a bank. Neither do they want to do it, maybe they should not be doing it, neither does the regulator want them to do it. So eventually this is going to be a mega trend which is playing out globally. This is something not happening in India alone. And we at NEO fundamentally believe, I think this is going to stay here for the next several decades.
See, on the connecting question to Lakshmi and Vineet, see today if you see the credit space is predominantly dominated by PSUs and AAA on one side, one end of the spectrum. On the other side you have venture debt funds and other risky real estate credit funds. So do you think like there is a lot of white space which needs to be filled in between for credit fund category? That is one question. And second, Vineet, maybe you can also add, like, because there is always, there is a confusion between performing credit and high yield or non-performing credit or whatever you may say. So maybe you can just elaborate on that as well. So question to both of you.
So the first part of your question, the answer is yes, because as I said, incrementally pooled vehicles like mutual funds are gravitating towards, and since April 2020, ever since COVID happened, and then we had one mutual fund, winding down their few schemes, we've actually seen the peak of spread widening at that point in time. Till now, the credit assets or the spread assets, as I call it, have been the best performers. Now, we've come at a time and stage where I would say banks are competing with mutual funds, lock, stock and barrel for the same set of credit, obviously because of the credit offtake and the high liquidity that we had in the system. And therefore, that space has become very crunched. Therefore, there is an opportunity, I would say, beyond the AAA, I would say the A plus, A minus, BBB plus. There is a space in that 10 to 12% sort of a bucket, which willy-nilly, from a taxation perspective, AIFs don't really find it very lucrative because, to your earlier point, risk-frees are giving you close to about 7% on a post-tax, post-index basis. So what is the delta? At a 10, 11% gross portfolio, I net yield you just about 6.5. So it's nowhere near competitive. So probably weaning some of those tail end 10, 11, 12% into a mutual fund portfolio, that could be an option which could be explored within the credit risk space, or creating, a garland of the 10 to 11, 12, 13% space, because there are very few who are operating in this space, as I said, mindfully, because of the taxation and the sovereign rates going up today. SDL, state development loans, which are, where the interest rate, the debt management is done by Reserve Bank of India, and therefore akin to a sovereign risk, is offering you close to little under 8% at the higher tenor. So if you're able to run with the interest rate volatility, the question therefore somebody will ask, why should I come to you in an AIF with a 10% gross yield? The answer is there'll be no takers, hands down, unless you do it for a very short period of time. So a liquid fund today is yielding you close to about 7%, little under 7%. So if you are able to create a 2.5% additional over and above that in the very short span, probably there are takers. But the cream seems to be more in the 13 to 15, 16% kind of a bucket, which is not very low, yet reasonably commensurate for people to be able to make meat, as I said, make it palatable for the investment fraternity at large. And of course, the beyond 18, 20% or the 22% treads into slightly more specialized and nuanced territory. You call it special situations, you call it restructure credit, whatever name you call it, that is a very, very different genre of investors. To some extent, we can say in that credit risk space which mutual funds were to offer, or the channel partners which probably market those strategies, they could find favor to some extent in that 12, 13, 14% bucket, but it's very unlikely that they will, try to find immense favor in that 18, 20, 22% bucket. So therefore, that segment is still pretty much, I would say, the bedrock for large institutions, whether it's in India or for that matter abroad.
Vineet, still some part of the question remains unanswered. So one is on the lower end, like what same question which has typically dominated with PSUs, and the other one is the high yield category. So I think like you operate in a very different zone. So is there large white space, and how do you differentiate between high yield versus performing credit? What is performing credit?
Yeah, so let's understand performing credit first. I think very simplistically it is assets which haven't defaulted, and therefore the value is coming in more through cash flows and let's say collateral versus a purchase price that is linked to the recovery of an asset, right? So that kind of gets the definition of performing credit out of the way, right? But more fundamentally, I think let's look at the market on both sides, supply and demand, right? Now the demand for money is today coming in from close to 13,000 EBITDA positive, unrated BBB and single A rated companies that exist, that today have an outstanding borrowing of around $100 billion, right? Now this is the market which today is unexplored, right? Pre-2018, this market used to be around 15% of the issued bonds in the country. Post-2018, it's come down to 4%. That's it. 4% of a $500 billion corporate bond market is 13,000 companies. So that's why AIFs exist, right? Because that's the market that we're all trying to tap into, figure out how you can price it, assess it, thrash it out, package it, diversify the hell out of the risk, and then bring in various types of investors, right? So very clearly the demand for money is very, very significant, right? And if there are more players like many of us on this panel, right? There will be enough and more takers for the money, right? Now let's come to the supply of money, right? On the supply of money, today the vast majority of the retail space is either very, very well invested into mutual funds or fixed deposits, right? May not necessarily have the opportunity to participate in the higher risk segments. Why? Because there is a 50 lakh limit for PMS and a 1 crore limit for AIFs, which automatically excludes a large part of the market. But even after that, the HNI market today is very, very robust and well able to appreciate the kind of risks that exist in diversified AIF portfolios. Having said that, the feedback that, one feedback that an investor once gave struck with me. He said, I don't want a cocktail, give me a single malt, right? Which effectively for us translated into saying that it's a wide market that ranges from, as Lakshmi said, 10 to 18. Segment it further, right? Today the funds that we work on at Vivriti sub-segment this into buckets of 200 basis points each, because each of those sub-segments represents a different kind of a risk which is offered as a different fund, right? Which we try to do to sub-segment the performing credit space further to make it easier to understand, benchmark, and for people to really kind of see where we stand versus where somebody else stands, right? But it's a very large market. It's a very wide. It's definitely a wide space. I think certainly the tide is changing in terms of appreciation of fixed income or equities. But even today, less than 25% I think of AIFs are fixed income. So very long way to go.
So now slightly shifting gears, that.
So this is the first time in at least 15 years I'm being outnumbered by the fixed income guy.
And I always get outnumbered in general.
Yes.
So we have a competition.
See, you're the lone man, you're the lone woman standing, right?
Typically,
Yeah,
most of the panels are equity panels.
So probably it's a sign for me of a changing trend. Money is
More
moving from
importantly-
equities to fixed income. So
Nice.
Let's hope so.
The objective of having a lot of people from the fixed income is administratively fixed income is little more complex compared to equities. So that's what on the fund administration panel we thought like we'll just have it. In fact, we had a wider representation. The keynote speaker was Prashant Jain, so it was.
See, we don't have an option. Whatever rate the NSE gives, you have to value it at that.
Absolutely.
There's no option.
So, Siddharth, now coming to you on the risk perspective. So now let's talk something on the risk because AIFs are perceived to be risky. Okay. So in terms of governance framework, okay, how do you manage the fund? So because there could be a stress situation. So in that kind of situation, like how do you have the risk management process, especially for Cat 3 funds?
So typically risk management would be the same, whether it's a mutual fund or a PMS or an AIF. At the end of the day, you would have to have the same risk management systems in place. At the most, what we get is a 1 month leeway for meeting our redemption requirements. Whereas in case of mutual fund, they have to do it on an overnight basis. So risk management, according to me, whether it is debt or whether it is equities, at the end of the day remains the same. And it is, don't lose money for your clients, right? It's as simple as that. So I think the framework across all asset classes remains the same. Invest with a lot of margin of safety, right? So invest whether it's, like when I hear these guys talking about diversification of bond portfolios, that is the same thing that we talk about in the equity markets, or it could be real estate. So everywhere you go, it is the risk management systems across asset classes, across geographies remain the same.
So now coming to you, Hemant. So you touched upon a topic of probability of default and loss given default, okay? So especially in private credit markets, right now things have been good. One crisis situation, then this becomes an important parameters in terms of what is the probability of default and what is the loss given default and what is the impact it will have on the investors' investments. So how do you assess that because you in the previous organization and even in NEO, so you have been predominantly handling large amount of funds. So what is the risk management practice and how do you have a mechanism to evaluate this?
Sure. So firstly, I must tell you, I think these are slightly more jargons at this stage of our industry's evolution. Probability of default, loss given default. The one thing I want to leave with people in this room is, I think if you look at private credit as an industry, it's been there in the US for the last 25 years. The world's largest funds are private credit funds, whether it's Blackstone, Oaktree. Okay? And they've been there for 25 years. I'll give you a staggering statistic given, and I'm going to come back to risk management pretty soon, Senthil. All said and done, the proof of the pudding lies in the outcome also, right? In the last decade, S&P has delivered 8% dollar returns, right? The US equity markets have delivered 8% dollar returns and it's come with its own share of volatility. If you look at the median private credit fund in the US, median, I'm not even talking about the top 25 quartile, the median private credit fund in the US has delivered 10% dollar returns. It's actually more than the US equity markets, and the US equity markets have had their best run in the last 10 years. So here is an asset class, despite, probability of default and loss given default. Here is an asset class which can give you a great substitute and maybe one more vehicle to be used in your allocation pool. If something can beat S&P over the last decade, be far more resilient in returns, I think it is imperative for investors to understand such an asset class. How do we manage risk? I think credit is a relatively simple business. I don't think it's a complex business at all. Fortunately, everything can be quantified. In fact, when I talk to a lot of people, equities is a business where it's a lot fuzzy. Credit is a business where it's very quantifiable. And you know when things have started going wrong. I think when cash flows stop coming, when cash flows become irregular, you don't need anybody to tell you that something is wrong. Something is 100% wrong. Okay? And I think frequent, brutal reviews on cash flows, I think that's the first early sign of trouble coming. And I think how you react as an institution then, as an organization, because these are organizations, right? You need to react as an institution. Whether you work with the borrower, whether you enforce the collateral, whether you do some sort of moratorium again, I think that's a judgment call that needs to be taken at that point of time. But I think past monitoring, relying only on cash flows, not fooling yourself by hope. If cash flow is not coming, then something definitely has gone wrong. Accept it. What you do next, and be decisive. I think in the business of credit, it is extremely important to be decisive. Typically what happens in banks is when there's a consortium of lenders, it sometimes just takes 3 years for the consortium just to come on the table. If there are 30 lenders, it's just impossible to come on the table on the same time, right? And you're leading to degradation of the asset. See, कोई asset now overnight खराब नहीं होता. 6, 9, 4 साल लग जाते हैं degrade होने में. फिर उसके बाद exponential degradation होता है. So I think track cash flows, be honest on your assessment, and then be decisive. I think that is simple risk management in the business of credit, according to me.
Perfect. So, Vineet, just a connecting question to this. See, there is a general perception that alternatives have a very concentrated portfolio, unlike the mutual fund. So, do you really believe that it's maybe for your funds or generally as an industry, is there a very concentration risk?
I think these concepts are changing, and possibly what you're referring to is what we saw pre-2018, 2019, where the most prevalent form of a private credit fund was high yield stroke special situations stroke real estate, where transaction sizes were very large. So a fund of say 2,000 crores could have 6 exposures, right? And take a very concentrated bet on a few select cases. Things have changed substantially. For example, the entire venture debt community today, right, would probably have an average ticket size of say 30-35 crores per exposure in a fund of 1,000 crores, right? We are seeing something happening very similarly in performing credit as well, right? The minimum exposure would be very comparable to a fixed maturity plan, right? The average exposure level could be anywhere between 1.5 to 2 times the number of companies, I mean, per scheme than what you would see in an FMP. So these things are changing, and as we are seeing a larger profusion of fund managers, risk management and portfolio management through diversification is becoming much more apparent.
Okay. So now coming to you, Lakshmi, from an investor's perspective, what do you think is the ideal asset allocation for an ultra high net worth individual to allocate to alternatives? See, it can be discretionary, but I'm just talking about an ideal scenario.
It is actually very discretionary, because your question already had the answer. Because the thing is, what is the risk appetite of the individual is what, one needs to clearly ascertain. And in this particular case, you have alternates being offered for multiple underlyings, for unlisted venture debt, which is like 10, 12, venture equity, which is like 10, 12 years. There is something which is offered in equities, in listed equity space, which could be just maybe 2, 3 years. And then you have credit offerings, which are in the band of 3 to 5 years. So I think the landscape is pretty broad. And therefore, even today, when we scan through some of the investor portfolios, and predominantly non-institutional, because institutions still find favor with largely mutual funds and or traditional mode of investments, which is bank products, they are very, very sparing exposure to the alternates. I think today, even today, alternates form a tail-end allocation of the investor's portfolio. So I would say tops I have seen is not more than 20-25%, and somebody who's just nibbling into it is probably in the band of about 5 to 10%.
Okay, perfect. See, I think we are overshooting the time. One last question for each of the panelists. Over the next 10 to 12, next 12 to 24 months, which are the sectors or themes which you would bet on? Vineet.
So our bets are on sectors which to my mind are very, very important to the government. So the entire climate space, huge investments by the government, definitely on logistics, definitely on healthcare, right? We also like sectors where we see the private equity industry as having good interest and exit opportunities, because then the sectors that we are in get well financed by equity. So financials definitely is an area that we also like a lot. That would be our top 4.
Siddharth?
I think a caveat here, we've been invested in this space for a while, but we've been very bullish on infrastructure for the last 2-3 years. Infrastructure, capital goods, manufacturing, we see the China plus one theme playing out. Exports, right, order book for most of the companies are very full as far as exports is concerned. So I think manufacturing looks good, infrastructure, capital goods. Pharma is a space where probably value has just started about emerging. And automobiles, again, India is a highly underpenetrated market. And as income levels increase, autos should do well we are extremely bearish in financials and on, and on consumption.
I would say themes which have a domestic bias and to a lesser extent, dependent on globe. I think that would be a segment which one should look at. And in that, I would say, I would segregate the BFSI space as banks and non-banks. Banks remain constructive. Non-banks still, there could be some, probable challenges. IT is a segment which probably with a lag could start doing well, purely from a mean reversion perspective, and no incremental bad news could be good news. So, something from that perspective, but probably it will take maybe a couple of quarters to unfold. And yes, a theme within the infra pack, which is cap goods and industrial, is something which has got renewed focus in this budget. I think some of those underlyings clearly hold a lot of value.
So you broadly covered almost 70% of the industry landscape.
Yeah, I mean, see, because ultimately, some of these segments continue to look expensive, but from a perspective of relative valuation, the country is not cheap either.
Yeah.
So you have to clearly cherry pick some of those places. See, India has always traded at a premium, but it's a degree of the way, and ultimately beauty or anything is always at a price, and so is investments.
Very optimistic on the domestic story. So Hemant, your bets, Hemant?
So, see, fortunately, we are in the business of credit. We don't want to bet on any sectors. We just want to bet on cash flows. I think agar cash flow hai, it's amenable for investing. So we need companies which have cash flows, manageable debt levels, will pay us our coupons frequently. I think that's what we want. Anything which has good cash flows, we are open for investing on those. Would not hazard. We are not in this business of crystal gazing, getting bets on sectors going. Just get basic cash flows, get your coupons paid, be happy as a creditor. We live a rather unglamorous life, Senthil.
So if not sectors, at least any themes which you bet on?
So we like asset-heavy companies, As a creditor, we would love asset-heavy companies. Some things which equity markets don't like, we love as creditors, because asset-heavy companies, the replacement value keeps going higher. I think inflation helps us. If replacement value is going higher, I think cash flows are going higher. So we like asset-heavy companies, manufacturing sectors, I think. Hard assets. I mean, anything which can produce cash flows and which replacement value goes up with inflation are good friends for us.
Senthil, in our dealing room when we chat, the discussion is always around top line being vanity, bottom line being sanity, but cash flow is actually the reality. Because ultimately, whether it's debt or equity, भाव भगवान है तो वैसे ही cash flow भगवान है. Cash flow जब दिखता है, माल हाथ में दिखना चाहिए. I think that's very, very important.
Brilliant closing remark. Yeah.
Paper examination and results.
So thanks. It was a wonderful panel, wonderful discussing with you. Thanks, Hemant. Thanks, Lakshmi, Siddharth, and Vineet. We look forward for more such discussions.
Thank you so much, ladies and gentlemen, for this amazing session over here. So for the felicitation, may I please call on stage Aditya Gargi. Can we have a huge round of applause for this amazing and powerful session out there, guys? Thank you so much, and that was an amazing session out there, guys.